The United States is home to 73 million baby boomers, and every single one of them could be retired by 2030. But here's the kicker. Nearly half, 45% to be exact, haven't saved a dime for retirement. They're also becoming the fastest growing demographic among the homeless population. So if everyone keeps saying baby boomers are the richest generation in history, what gives? Where did all that wealth disappear to? Picture this. When you imagine retirement, you probably envision yourself lounging on a beach in Costa Rica with a spicy margarita in hand, or maybe cruising through Miami in a convertible, cash stacked high. Now let me introduce you to the three-legged stool of finance. This stool symbolizes the three primary income streams retirees typically depend on during their golden years. The catch? All three legs are wobbling dangerously. Let's start with savings. After grinding away for 46 years in the workforce, you'd expect to have a substantial nest egg tucked away. Money you can gradually pull from once you clock out for the final time. Here's the harsh reality. The typical baby boomer is woefully unprepared. Nearly half have zero retirement savings whatsoever. Among those who've actually saved something, 28% have stashed away less than $100,000. Sure, six figures sounds impressive on paper, but consider this. Americans over 65 shell out roughly $52,000 annually just to survive. Between skyrocketing healthcare costs, gourmet sugar-free applesauce, and tickets to see Billy Joel live, you don't need a calculator to realize the average boomer will blow through their savings at lightning speed. And it's already happening in real time. Baby boomers have become the fastest expanding group experiencing homelessness. Back in the 1990s, only 11% of homeless individuals were aged 50 or above. Today, that figure has exploded to nearly 50%. Countless boomers nationwide are confronting a brutal truth. Dedicating your entire adult existence to work no longer guarantees you'll have shelter in your final years. So the savings leg is unreliable. What about the remaining two? During the Great Depression, countless working families found themselves jobless. Businesses crumbled, starvation spread, and food rationing became standard practice. Among the hardest hit were older Americans who, despite laboring for nearly 5 decades, found themselves destitute. President Roosevelt responded by enacting the Social Security Act in 1935, creating a financial safety net for retirees. Essentially, retirees would receive monthly government payments to cover necessities. But Social Security wasn't without cost. The government structured it as a pay-as-you-go system, implementing a new tax on current workers. From every paycheck, a portion was deducted and deposited into the Social Security Trust Fund. In exchange, workers received a guarantee they'd collect monthly payments from that fund once they retired themselves. And it delivered results. After committing decades to the workforce, retired older Americans could finally enjoy some leisure time without financial anxiety consuming them. Unsurprisingly, poverty rates among elderly households plummeted from 35% in 1959 down to 11% by 1995. Today, Social Security stands as the primary income source for retirees, with over 90% collecting these benefits. But everything's about to shift dramatically. Remember that promise the government made? Workers were guaranteed monthly payments from the fund after retirement. In the 1980s, President Reagan started draining money from the Social Security Fund, redirected it toward other priorities: wars, tax breaks for wealthy Americans, and various government initiatives. Presidents Bush and Clinton continued this pattern. To replace the trillions they withdrew, they simply inserted IOUs, pieces of paper promising the U.S. government would eventually repay the debt. Spoiler alert, they never really did. The Social Security Fund has operated in the red since 2010, meaning outflows have exceeded inflows for over a decade. During their working years, baby boomers represented the largest generation in America. They pumped massive amounts into the fund for the silent generation to withdraw from. Now that this enormous generation is retiring en masse, they're beginning to reclaim some of that money. The problem? Fewer workers are currently paying into the system. Projections show the Social Security Reserve Fund will be depleted by 2034, meaning all new benefits will come straight from current payroll taxes. But those taxes will only cover 77% of promised full benefits. Think of it this way. If you were promised a $1,000 Social Security check monthly, you'd now receive only $770. As living costs continue rising, a 20% income reduction is devastating. Here's the thing. Many Americans treat the 2034 timeline as a certainty, but it's not. It's a warning based on optimistic economic conditions. It doesn't account for the unpredictable chaos that could erupt during an economic downturn. Since 2019, the gap between Social Security's promises and expected payments has ballooned by nearly $10 trillion, more than 40%. For every dollar collected in payroll taxes, the program has generated roughly $2 worth of promises nobody expects it to fulfill. But what about that third leg baby boomers might lean on? Before the 1980s, pensions were the standard private retirement option. Companies would allocate money for employees, invest it on their behalf, and guarantee payouts after retirement. It was an era when employer loyalty actually mattered. The longer you stayed, the bigger your eventual payout. Then, Ted Benna revolutionized everything. He argued pension plans were too expensive and risky for corporations, so he took action. Enter the 401k plan, a significantly worse retirement alternative in virtually every conceivable way. Now you set aside your own money, you select your own investments, and if you fail to do this, tough luck. Companies embraced this alternative enthusiastically. It required far less effort and carried minimal risk for them, so many abandoned pension plans altogether, migrating to 401k plans instead. This transferred retirement costs from employers directly onto employees. The timing couldn't have been better. Two stock market booms during the 1980s and 1990s easily persuaded workers that managing their own 401k was superior. From 1980 to 2008, pension participation dropped from 38% to 20%, while 401k participation jumped from 8% to 31%. The problem? An entire generation with zero investment experience was now gambling their retirement savings while chasing the bull market. Steve Shoemaker and Dan Robertson, two public school teachers with limited financial knowledge, watched everyone raving about 401ks and decided to join the party. By 1996, they doubled their retirement nest egg to $500,000. By 1999, their portfolio topped $1 million, and they felt invincible, convinced they'd made the smartest financial moves of their lives. Then, the early 2000s arrived. The dot-com bubble exploded, and Shoemaker and Robertson watched their fortune crater from $1.5 million down to $500,000. Tens of thousands of people on retirement's doorstep were suddenly forced back into the workforce because they'd lost everything. But the nightmare didn't end there. Whenever money and investing collide, you can bet Wall Street discovers opportunities to profit. Meet Robert Hilton Smith, an economist who consistently contributed to his 401k, who noticed something suspicious about his account one day. Despite strong market performance, his 401k barely grew. After digging through documents for days and weeks, he finally uncovered where his money was vanishing. The plan was invested across more than 20 different mutual funds, each charging its own set of costs and fees. Asset management fees, trading fees, marketing fees, record-keeping fees, administrative fees, fees for not realizing there were fees. It never ended. A 2–3% fee might appear trivial, but here's the reality. Just as investing compounds your wealth over time, costs and fees also escalate exponentially. Suppose you've got a $60,000 investment portfolio. You plan contributing $500 monthly for 25 years, growing at an average 8% annual rate. You'd end up with $884,000. Substantial money. But introduce a 2% fee and you're left with only $606,500. That seemingly insignificant 2% fee just cost you $278,000. In 2012, Hilton Smith calculated that the average American family pays nearly $155,000 in 401k fees to Wall Street over their lifetime. But it gets worse. The justification for these astronomical fees is that professional fund managers actively manage your 401k investments to outperform the stock market. The reality? Approximately 51% of actively managed funds fail to beat the market. You'd literally be better off hiring Orlando the cat. In 2013, Orlando outperformed experienced, credentialed wealth managers at stock picking. Best part? Orlando doesn't demand hidden fees, just an occasional can of tuna. Roughly 12,000 people will celebrate their 65th birthday every single day throughout 2024. The problem? Their 401k plans are getting decimated. Fidelity discovered that average 401k balances dropped 23% in Q3 of 2023, and many anticipate the stock market will deteriorate further. According to McKinsey, Americans are living longer than ever before, thanks to improved working conditions and healthcare breakthroughs. Life expectancy has nearly doubled since the late 1890s, which is fantastic. We all get more precious time with our parents and grandparents. The only issue, retirement now requires far more money than we, our government, and our economy originally projected. In economics, there's a concept called the old age dependency ratio, essentially the number of individuals over 65 per 100 working age people. The higher this ratio climbs, the heavier the burden on the current workforce and broader economy to support retirees. Government services get stretched thin. Taxes on working populations must increase to cover mounting expenses, and there's potential pressure to raise the retirement age for future generations. The average old age dependency ratio across OECD countries like the UK, Australia, and Germany sits at 28, meaning for every 100 working age people, there are 28 individuals aged 65 or older. This ratio is projected to hit 50% in the US by 2075. As housing, education, childcare, and food costs continue skyrocketing, many Americans are barely scraping by. Consequently, more young people are refusing to have children. Think about it. Our entire social and economic infrastructure mirrors a Ponzi scheme. If the next generation isn't larger than the previous one, nearly everything collapses. Naturally, as you age and retire, most expenses decrease. No more overpriced cocktails at bars or purchasing the newest tech gadgets. But one expense will inevitably surge, a particular crisis baby boomers will confront head-on. A 2017 research study determined that a healthy 65-year-old couple retiring today will need approximately $275,000 to cover healthcare costs throughout retirement. Doctor visits, 20 different medications, stress balls. 70% of baby boomers will require some form of long-term care, assisted living, hospice care, or nursing homes. The problem? Average nursing home costs range between $7,908 to $8,834 monthly. So where exactly are baby boomers supposed to get this kind of money? Most lack adequate savings, Social Security faces cuts, and 401k plans are crashing. You might think Medicare is an option, federal health insurance for people over 65 that's more affordable than private coverage. The problem? Medicare doesn't cover long-term care. So the alternative is Medicaid, health insurance for low-income Americans. But qualifying for Medicaid requires being at or below 133% of the federal poverty level, meaning most middle-class boomers exist in limbo, too poor to afford necessary care, yet too wealthy to qualify for Medicaid. Even if they secure long-term care, there's another obstacle. Getting into nursing homes is harder than ever. Facilities are experiencing severe staffing shortages, overcrowding issues, and many operated losses. Consequently, over 1,000 nursing homes have shuttered since 2015, with more closures inevitable. But there might be one final lifeline for baby boomers hoping to maintain decent quality of life in their twilight years. Their children. The problem? Millennials face their own struggles. Housing unaffordability, stagnant wages, and an impending debt crisis. Many won't be able to take time off work to provide the complex, ongoing assistance their parents require, and they can't afford to quit because single-income households can no longer survive. Some millennials will be forced to reduce hours or seek jobs with greater flexibility, potentially resulting in lower pay. This means they'll face an agonizing choice between caring for aging relatives and their own financial survival. Personally, family comes before everything else for me. But for many millennials, they'll need to determine whether they themselves will have enough money when retirement arrives. A 2006 research study found that when family members over 50 assume unpaid caregiving responsibilities, they lose on average over $303,000 in lost income and benefits, a staggering amount. But it's more than just money. There's the mental, physical, and emotional exhaustion you'll inevitably experience. And what's even more heartbreaking, you end up in a strange dynamic where you wish for the day when you don't have to deal with daily caregiving stressors, and then you realize you're longing for the death of your parents. which is a strange, terrible place to be.